everybody. Thank you for joining myself, Tim, and Billy here for another week of market updates. So recently we've had a lot of news around the China reopening. There's also been talk about the Fed and interest rates. But first we'll focus on China because that's been a really big story in this part of the world. Obviously, being in Singapore and investors being based in Asia, what happens in China is a big deal for stock markets regionally. So recently we've seen China maybe shift a bit in terms of its mentality towards COVID reopening and maybe ditching the so-called dynamic zero COVID strategy. So if there is a reopening in the next sort of 3, 6, 9 months, Billy, how do you expect it to pan out, and what do you expect to see going forward?
Yeah, I think firstly, thanks Tim for the introduction. Yeah, I think that if the reopening were to happen, I think it would be beneficial for I think the players that are very prominent in China, for example, Apple and Tesla, and of course I think the EV players, because the EV supply chain in China is probably the most comprehensive that we have globally. So I think the reopening would give that sort of comfort to investors, right? And I think there was a bit of a story that if we follow, there was mentioned that, the iPhone 14 Pro, there will be a delay of about, I think, 6 million iPhone Pro, right? So that would translate to, I think, about $6 billion dollars of revenue for
dollars in revenue.
Yeah, so
right.
that is huge in a sense, right? But I think what is needed, I've been talking to quite a bit of Chinese players from NIO, as well as some of the players who used to be in Malaysia that they went back to China, and I think there is a bit of I think I can't really say confirm that there is going to be reopening, but the government has actually eased in some of the restrictions. For example, there is no longer the terminology for contact person to the close contact person to a close contact. There used to be looking at, if you're close contact to someone who has COVID, and another layer that is close contact to. So basically 2 layers. Right now they're only looking at 1 layer. So we can see that sort of shift in terms of the stance that there is, and which is why I think if you look at the share prices, you can see NIO and some of the EV players, they're moving up. So I think that's where the most impact would be, because I think personally I think there is a lot of uncertainty especially for EV players and those manufacturing players that have hub in China, in terms of whether the reopening is real or not. So we can see that sort of up and down in swing in the market prices every time there's news on that front. So I think once we have a clarity on the reopening, that will really pave the way forward for some of these players, right?
Yeah, it's quite interesting to see the price action, because there were the protests in Guangzhou and other places in other cities, over the weekend. And I think coming into this week, there was fear that would be a massive, downdraft for the market. But actually the market ended up rallying. So it's a surprise, because I think there was the expectation that the pressure of these protests would force the government's hand in terms of actually trying to accelerate the reopening, to quell the protests in a sense. So actually it's had the reverse effect of what a lot of people thought the protests would have on the markets. And so I think a lot of investors generally have recognized the fact that when China does reopen, there will be a relief rally, and it will be pretty strong, I think, in terms of the price action. And we've seen some of that this week. As you were saying, there's local governments are starting to loosen restrictions. I think just today, Beijing local government has said that low-risk patients can isolate at home, self-isolate at home for up to a week. So I think these are things that were probably unthinkable even a few weeks ago or a few months ago, and now they're starting to become more of a reality. So I think you're starting to see that loosening up of restrictions, but this is certainly not going to be an overnight transition. It's not going to happen, tomorrow or next month. But I think there is the talk of obviously trying to get more older people vaccinated, because in China there's really quite a low percentage of the elderly population are actually vaccinated against COVID. So I think there's going to be a push there as well from the government. So I think all the signs are pointing to some pretty positive reopening signs, but we have to temper our expectations, as in it won't be overnight. It will take time. I mean, a country rather the size of China, it will probably you're probably looking at least 6, 9, 12 months of gradual reopening to see what happens. But a lot of the big consumer names have rallied this week. The likes of Shabu Shabu, and then was it Heidi Lau? That's also done very well. So I think some of those big consumer names in China have done really well this week. And so in terms of where they're going next, there could be a continued rally that's also sparked by the Fed, which is, I think, provides a good segue to the next point about, the Federal Reserve and where they see interest rates. I think markets in Asia have rallied quite strongly because the Federal Reserve is thinking of slowing down the mega-sized or jumbo-sized rate hikes that they've carried out so far in 2022. And so what do you think, the latest comments from Jerome Powell, the Fed chair, and other governors at the Fed implies for where the Fed funds rate is headed?
I think it's the realization that you can't go too fast at too short a time, and I think that's positive for not only the market. I think for consumers as a whole. I think the fact is that I think over the last decade there is I think 10 trillion of debt added to the market, and so higher interest rate will lead to higher interest costs, and that is going to eat into the household disposable income. So I do think that this is a realization of that, but of course the Fed has the room to maneuver, I would say, because if you look at the household excess savings in US, it's still at 1.7 trillion. This is after the because during the COVID there is a lot of fiscal stimulus, right? So at one point it was at 2.1 trillion and above. So it came down a bit, but it's still at 1.7. So there is quite a bit of buffer for
big cushion.
Yeah. So I do think that the slower interest rate hike is good, especially the fact that this is probably going to pave way for the unwinding of the Fed's balance sheet as well. Bear in mind that the Fed balance sheet stood at about, I think at the highest one at 9 trillion. It came down to 8.6 now, and I think they were gonna reduce it about 95 billion every month. So I think there is a lot of considerations that the Fed has to look into, and this is probably some sort of relief for investors that the Fed are looking into all this as well, rather than just tightening at all costs. So I think this is probably good news for the market.
Yeah. I think it's I think the speech by Jay Powell yesterday confirmed that what everyone is expecting anyway. I think it's going to be 50 basis points in December, but the question, there are 3 questions, right? The first question is being answered about how fast they will hike. I think that's starting to slow, but then the other 2 are still unknowns, right? Where will it end up? And then how long will it stay there? Like, how long will it stay elevated at that rate, right? So, expectations right now are for 4.5 to 5% next year, but that could move over the next few months, and that could end up being higher expectations, closer to 6%. And then how long do we stay there? So there are lots of other data dependent factors that are going to come into play, but it's going to really rely on inflation and the labor market, right? So I think those are the 2 things that investors will want to watch going forward. But in the meantime, it's proven to be pretty good for the markets, as we've seen so far. There's been definite relief that at least the rate hikes are starting to slow. But I think we're not out of the woods, right? I mean, as you were saying, Billy, that the consumers have savings, which is good, but there is likely to be a recession in the US, or we maybe are currently in one. At this point, we don't know. But over the next 3 to 6 months, we'll find out how bad some of the earnings will look, because I think earnings is going to tell the story for investors for how bad this recession can be.
Yep. And I think if you ask me, I think the biggest takeaway from this is that I think there's always been the concern in terms of Fed's policy mistake that will lead to a sharp recession. And I think whatever that came out, I think it shows that the Fed are looking into all of this. And I think this provide that sort of relief that, we are probably not going to see that sort of mistakes that will lead to a sharp recession or collapse in the economy entirely. So I think that's the positive takeaway from this.
Yeah, because I mean, it's important for investors to remember this is the fastest they've raised rates in 40 years, right? So you're talking about a debt amount that is the highest ever, and interest rates being hiked at pretty much from 0 to 4% in the space of 9-10 months. So the lag of monetary policy into the real economy, it takes time, and that's not well understood at this point. So I think the Fed is being responsible in understanding that they want to give it a few months or, a few quarters to see how it plays out at a higher terminal rate to determine whether they want to continue hiking or whether they're going to slow and pause. But I think it's good policy makings to kind of see, because we haven't had this kind of environment in 4 decades, right? So I think it's a very unique environment, and with labor participation also, at a low as well. So it's something which has seen the labor market remain extremely tight. So there are lots of considerations for the Fed to take into account before their December meeting. So it'll be interesting to see what happens then. Mm-hmm. I think that's about it for now for this week. And so I think next week we will be looking into other factors impacting the market. But for this week, thank you for joining me and myself and Billy. And thank you, Billy, for taking the time out. And we hope you enjoyed it. So until next week, thank you, everybody.